Welcome to the HMO Property Show, by investors for investors. Brought to you by the HMO Property Co, Australia's leaders in impact investing. Investments made with the intention to generate a measurable, beneficial social or environmental impact alongside a positive financial return. Catch us weekly as we discuss all things cashflow positive property investing.
Welcome back to the HMO Property Show. I'm your host, Neil Gibb, as always, and today I'm going to be talking about self-managed super funds and how to build new build HMOs and NDIS properties inside your self-managed super fund. But this is a very regulated area, so first and foremost I'm going to put this disclaimer out there. I am not in any way, shape or form licensed to give you advice for superannuations or self-managed super funds, and you 100% need to take advice from suitable professionals. I can connect you with these professionals if you need be, but please make sure that you do not just take this advice and go out there and do what I ask you to do or inform you of what can be done. Make sure you get advice from the suitable professionals. The information in this podcast is based on the journey of some of my current clients and the projects that they're currently completing. So the reason that I want to do this podcast is lots and lots of people are reaching out to us now with money in their super funds. Some of them don't have self-managed supers, they just have large superannuation balances. And I think because recently the Australian government announced that the upcoming changes to the tax concessions for superannuation balances over $3 million, which essentially means they're going to tax you 30% instead of 15% on any balances over 3 mil. And this doesn't come into play until July 25. And it only applied from the 25 to 26 financial year and onwards. But it still spooked people because the government, our good friends, the government there, keep just changing the goalposts, don't they? They put something in place. They say, Australians, what we're going to do, we're going to make sure that your employer or yourself can contribute to a fund that we tax you less on, which you can then use for your retirement in the future. So everybody starts putting more and more money into these things, and all of a sudden they go, oh, by the way, we're going to tax you at 30% now instead of 15%. So, the government just cause so many problems, really, don't they? And they're always there just with a handout, thinking they deserve it more than you. And don't get me wrong, I've got nothing wrong with paying taxes. I think this country is an incredible country because of the taxes that we pay. However, I think we pay a lot of taxes. There is some really good vehicles out there for minimising your tax, and you can check out, I think it was episode 2 or 3 that I did with Nitin Vashisht, and we talked about asset protection and tax minimisation. But yeah, the government just keep changing the goalposts, and for a business owner and an entrepreneur or somebody in property, you really just have to adapt with these changes, because you can sit there and moan all you like, but if you don't go with the changes and you don't look for these opportunities, because chaos equals opportunity, then this is what we're here for. We need to pivot with the times, change with the times. Pivot's just a fancy word for change direction. So look, lots of people are reaching out to me. I did see a company out there not too long ago. I think they were called something along the lines of one part contract or one contract property. The reason that they call themselves that is because in your self-managed super fund you cannot buy a block of land and then enter into a build contract with a builder and then use borrowed money from the bank to build that house inside your self-managed super fund. And I'll get into why you cannot do that soon, but you just can't do that, right? So one part contract came out, or one contract property, and they started saying to people, we'll do it for you. We can take care of this build outside of your super and then sell it into your super for you. But the clause around this was you needed to pay a 35% deposit into their account, and they use that money to technically build your property. And then they also charge you $150,000 for the privilege of doing that. And it took me a while, a lot of meetings with my team. I'm a business partner, and I said, look, this is a good way for people to get new product in their funds. However, I'm just not comfortable with the $150,000, a lot of money. That's $150,000 from somebody's retirement that, that could be essentially be almost another deposit on another property. So we reached out to all of our networks and connections and we said, look, this is what we've got. This is what we're doing. These are the outcomes that we create. What can we do? And lo and behold, we actually found a better answer. So what the way what we can do it is the exact same process, but instead of putting 35% into an account that the builder can use to build the property, we put 10% into a trust account, and it doesn't get used to build the property. It just gets held in trust, and then 6% gets added to that house and land contract price. So let's say, for instance, a typical house and land package in the HMO and NDIS space is block of land $300,000, build contract $600,000, so your total's $900,000 all up. Now, if you were to enter into that contract outside of your super fund, you would pay $9,000 stamp duty on the $300,000 block of land. But because we're going to go down the one contract route, we need to essentially build that property outside of your self-managed super fund and then sell it into the self-managed super fund once it's complete. So the way that we do it, it would be the total is 900,000, 300,000 for your land, 600,000 for your build contract, plus 6%, so $954,000 in total. So that would be the price that you put on the offer and acceptance. And you pay stamp duty on that full $954,000, which would be approximately $40,000. Now, you put your 10% in the trust account. You then sign a contract to say, I will buy 10 Smith Street in my self-managed super fund for $954,000 once it's complete in the future. Excuse me, tickly cough. This other person then goes out and builds them, and then once it's built, they sell it into your self-managed super fund, and that 10% that you've already put in the trust account, that gets used towards the deposit on your property. So historically, we've been looking at 30 and 35% LVRs, but with the lenders and the funders that we're working with at the minute, we're getting 80% LVRs inside trusts. So if you're putting 10% into a trust account at settlement, you just need to put another 10% into the settlement agent's trust account. The other 10% will get moved in there, and then you put your stamp duty costs and your settlement costs in there, and then the title will transfer into your self-managed super fund's name, and hey presto, you are now the owner of a brand new full turnkey HMO or NDIS property that delivers between a 10 and 14% gross yield. So that's how we're doing it. By the way, if you want to find out a little bit more about superannuation and how it works and some of the loopholes that are out there, go back and check out episode 13 with Cornel Wilbers. We talked about superannuation, self-managed super funds, the pension phase of your superannuation, and how you can use that to pay zero tax. Not tax-free, zero tax. There is a difference, apparently. But basically, in a self-managed super fund as well, we use what's called non-recourse or limited recourse borrowing, which means that anything that's held inside that self-managed super fund, if for any reason you defaulted on the mortgage, then the lender cannot come outside of that fund looking for you as a guarantor and come after your assets because it's limited recourse within that fund. With the self-managed super fund as well, with a limited recourse borrowing arrangement, you are only allowed to purchase a single acquirable asset or one title. So building a house on vacant land is considered multiple titles by the ATO, one for the land and one for the build, and this is strictly prohibited. And this is what we spoke about earlier, where that's two contracts. We need it on one contract. So you need one contract to buy it in your self-managed super fund and access lending and make sure that you're not breaking any of the rules and you're keeping Mr. Taxman happy, because God help him if he doesn't get his tax, what's he going to do? So I hope that helps, guys. A lot of people, like you say, they're reaching out and asking these questions. I thought it was just a good opportunity to record a quick, short podcast. This week's podcast will be a lot shorter than normal. But next week we'll be back to normal. We'll have some super guests on. I've actually got Michael McGowan, who's the HIA Executive Director, coming on the podcast. That will be released next Wednesday. And after that, we've got some more guests coming in from the UK talking about HMOs in the UK, how they've used them to create wealth and passive income so that they can quit the jobs and have more time, freedom and time and money to spend time with their families. So I hope that helps, guys. If you've got any questions, as always, reach out to me or my team. If you've got some money in your superannuation and you're looking to invest in a self-managed super fund, or looking to invest in a HMO or an NDIS in your self-managed super fund, or create a self-managed super fund, please reach out to me. We've got all the connections here. I don't get anything from these guys if I connect you with them. I just want to make sure that you're connected with good people who can get results. The self-managed super funds cost $1,500 to set up, and they take 24 hours to set up with the guys that I can connect you with. Excuse me, quick drink. Once they are set up, the team that set them up can also take care of all your accounting services and auditing services that's required every year. And if you do set one of these things up, make sure you're good at admin. I'm not the best at admin, I will admit that, and every year is an absolute pain for me to go through my self-managed super funds, because we got multiple things in there. We've got shares, I've got some cryptocurrency, I've got some properties, there's all sorts in there. It's just the end. I actually dread the email every year. I see it land in my inbox and I'm like, oh God, not again. So yeah, make sure your admin is on point. So I hope that helps, guys. If you want any help, please reach out to me on my team. We are here to help. We are here to serve. We are here to help you make sure that you create cash flow from property so that you can retire early, quit your job, have more time, freedom, less stress, and enjoy your life. Peace out, and I'll see you next week.
Thanks for listening. Make sure you tune in the same time next week so you stay up to date with all the cash flow positive property updates.